if you look at the economic data, like I've said before, there's just nothing justifying a recession. Now we are getting some weak data points. Housing looks awful. It's getting worse. We finally got some really weak months within heavy trucking sales. Why this matters? If you look at heavy to medium truck sales on a year-over-year basis, they tend to go negative for a couple months leading into a recession. Now, there's no way you can look at this trend, these green trends right here, and say, hey, recession's on the way. But these are 3-month annualized, right? So this is kind of the trend before you get to year over year. In order for year over year to get where you want to, you got to first get these 3-month annualized trends leading in that direction. But we still have a reasonably okay consumer. They're definitely softening, getting weaker. Real disposable income is still okay. Employment comp received is still pretty high. Consumer sentiment is okay. And look at employment. It's still, it's softening, but it's not recessionary. This is not what you see in a recession. Now, what I find interesting is always within the employment data, temp jobs are the first to go. And it's always the first leading indicator for like a bottom and an explosion higher in unemployment claims. And we're starting to get that, right? We're accelerating on the downside with temp job claims. I added this right here as just kind of a very crude recession detector, which is when I'm looking at initial claims for unemployment. It's a 4-week average. And I want to see a month over month move of 5% or higher to kind of start that move. When it really gets going, it'll be like 20, 30% higher. If not even higher than that. But it's very, very stable moves right here, month after month. We're seeing deceleration, not acceleration. So until that happens, historically, you still have more juice in the economy. Employment is the second to last shoe to drop in the business cycle, followed with a long lag by inflation, which leads me to inflation. I've been talking about this for a long time, and it's finally starting to happen. Whether the market accepts it now or not, I think it'll be a matter of time before they accept it. But the CPI print decelerating, 3-month annualized trend, right? So if you want to get your year over year to 2%, you need to see 3-month annualized trend consecutively for many months be at 2 or below. And we started getting there. Look at that, 1.9%. And then what happened? Very large acceleration, 3.9%. Showing some kind of a bottom in inflation. So what happened? It was what we talked about. Food prices have their second month of acceleration. They bottom in July. And look at this huge increase in energy. This is what caused it. The good news is that core did decelerate on a 3-month annualized basis to 2.4. Now, the headline number, the year over year, is still 4.2, I believe. I think it's 4.2. So it's still more than double where the Fed wants it. So we need to see like this core CPI get to 2%, lower than 2%, 1% for several months to get that year over year to 2%. I think that's going to be unlikely, especially considering how prices are starting to go up. The consumer's feeling a little bit more confident about everything. But this trend, I think, is starting to play out. Now, if we look at it from a top-down overview, we're measuring inflation, which whenever inflation, the trend is up, that means that we're over on this grid right here, or this axis, the right side of this axis. Whenever inflation is going down, we're on this side of the axis, which really, it shows you like from August of 2022 on, we've been seeing deceleration in inflation, right? A little bit of return, but mostly deceleration. Then all of a sudden, reacceleration and large reacceleration of inflation right here. And you'll notice growth kind of stayed flat. I think that's going to be the trend, that we're going to be flat until we eventually move back down into this risk-off grid, which is basically inflation is accelerating and growth is decelerating. And that's going to continue until we get back into this grid, which is where things will probably start to unravel, which is when inflation starts to decelerate and growth decelerates as well. Once the growth starts getting factored in, like the lag effect of these rate cuts, eventually that's going to start affecting the economy. And when that does, I think it will probably be relatively quick when that starts kind of surprising people. But this right here is not what you want to see. You want to see us move higher into this grid over here and stay here. But it looks like we're making a sharp move back into, at best the risk on grid, which is high inflation, high growth.